Welcome to Value Vest Daily, where we deep dive into the best value and momentum investment opportunities. Today, we're talking about a company that might just be sitting on the answer to the biggest problem in the entire AI revolution: power. Now, that question on your screen, Bloom Energy to $300? It's a bold claim for sure, but we're going to break down exactly how this company could become one of the most critical infrastructure plays of the next decade. So, here's what we're going to cover today. First, we'll look at the massive problem that Bloom is set up to solve. Then, we'll get into the why now, the recent news that's put this stock on fire. After that, we'll dive into the numbers, see what the charts and the smart money are telling us, lay out the bull case for where the price could go, and finally, wrap it up with a balanced look at the verdict and the risks you absolutely need to be aware of. Let's jump right in. Okay, first things first, let's set the stage. This whole AI explosion isn't just about clever software and powerful chips. At its core, it's about brute force electricity. And the simple, kind of scary truth is, our current power grid is just not built for what's coming. It's already straining. And that leads to the multi-trillion-dollar question that giants like Amazon, Google, and Microsoft are desperately trying to answer right now. You see, building a new power plant or running new high-voltage lines can take 5, even 10 years. AI development moves in months, not decades. That huge mismatch between the speed of AI and the speed of our grid, well, that's where the opportunity is. And just to give you a sense of the scale we're talking about, a 50% surge in America's electricity needs by 2030. Let that sink in. And almost all of that is coming from new data centers. This isn't just a small hiccup. This is a tidal wave of demand. And the old way of doing things just can't keep up. So enter Bloom Energy. Their secret sauce is something called a solid oxide fuel cell, or SOFC. The easiest way to think about it is like a power plant in a box. It generates super reliable electricity right where you need it, like right next to a data center. And here's their real edge. These things are fuel flexible. They can run on natural gas right now and then switch to clean hydrogen in the future. That gives them a clear path to being carbon-free, which is a huge deal for these big tech companies. And this is exactly why data centers are lining up. I mean, look at the comparison. Instead of waiting years for the utility company, you can have power up and running in 90 days. And you get what they call 5 nines reliability. That's 99.999% uptime. For an AI data center, going offline is simply not an option. It's faster, more reliable, and cleaner. It's just a better mousetrap for this specific problem. Okay, so the technology is a perfect fit. That's great, but why is everyone suddenly talking about Bloom right now? Well, it's because a string of recent announcements has just poured gasoline on this fire and basically proved that their moment has arrived. Just look at what's happened in 2025. They expanded a huge deal with Equinix, the biggest data center company in the world. They announced a massive, nearly gigawatt-scale project just for AI. They raised a ton of money to grow, but the deal that really shook the market was the one with Brookfield. $5 billion. Let me say that again. $5 billion. This is not just some small vote of confidence. This is a global infrastructure giant basically saying, we believe in this so much, here's a fire hose of cash to go build it. This deal alone transforms Bloom into an absolutely essential player in the global AI build-out. Okay, the story is amazing. The catalysts are huge, but you know us, we have to look under the hood. Do the numbers actually back up the hype? Let's get into the financials. All right, let's break this down. That market cap shows investors are already pricing in a lot of success. And yeah, the first thing your eyes jump to is that trailing PE of over 2,000. It looks absolutely insane, and we'll talk about that in a second. But what's really important here is that the company is profitable, it's generating real cash flow, and its forward PE, what investors are looking at, is expected to come way down as their earnings explode. And speaking of exploding, look at this revenue growth. It's just accelerating like a rocket ship. Over 57% growth year over year in the last quarter. This isn't some slow, boring utility company. This is what an explosive growth phase looks like when a company hits a massive inflection point. And it looks like this is just the beginning. The forecasts are for sustained annual growth between 19 and 27% for the next several years. Some of the more bullish folks think it could be even higher, maybe closer to 40% when you look at the raw demand for power. This is the engine that could drive the stock for years to come. Okay, so let's circle back to that crazy PE ratio. Yes, it's high, but with a company like this, you're not paying for last year's earnings. You're paying for next year's and the year after that. The market is betting on that explosive growth we just saw. Think about it. Amazon, Microsoft, Google, they all had sky-high PE ratios when they were in their hypergrowth phase. Investors who waited for the PE to look cheap missed out on historic runs. So go ahead and put a circle on your calendar for February 5th, 2026. That's their next big report card. It's going to be our first real glimpse of how these massive new contracts are actually hitting the bottom line. It is a must-watch date for anyone interested in this story. So the company's fundamentals are pointing to massive growth. But what about the market itself? Is the smart money, the big hedge funds and institutions, buying this story? Let's take a look. Well, there's your answer. A whopping 77% of this company is owned by big institutions. This is not a meme stock being pushed around by retail traders. This is a high-conviction bet being made by some of the most sophisticated investors on the planet. And the stock chart totally confirms that story. The trend is strongly bullish, with the price staying way above all the key moving averages that traders watch. This shows sustained, powerful buying pressure. We've got clear levels of support below us and some targets to watch on the way up. But there is one little warning light flashing. And it's this indicator called the RSI. Right now, it's way up over 90, which is basically screaming severely overbought. Now, that doesn't mean the party's over, but it's like a sprinter who needs to catch their breath. It suggests the stock could be due for a pullback or at least some consolidation. For anyone looking to get in, it might be smart to wait for a dip back toward that support level around $100 to $107. So we have the story, we have the massive catalysts, we have the fundamentals, and the smart money is on board. So what's the potential payoff? Where could this thing actually go? Well, the analysts who cover the stock are pretty optimistic. In the next year, they're looking at targets around 122 on average, with some as high as 160. But when you look out 3 to 5 years, that's where it gets really interesting. We're seeing targets of $200, even $300 a share or more. If that happens, you're looking at a company worth anywhere from $50 to $100 billion, a true multi-bagger from here. So let's put that in real terms. Let's say you invested $10,000 today. If the stock hits that $200 target in a few years, your 10 grand could be worth over $18,000. And if it hits $300 by 2030, well, that could turn into nearly $28,000. That's the kind of potential we're talking about. But listen, no investment is a straight line up. Before you get too excited, we have to talk about the other side of the coin. Let's balance all this amazing potential against the very real risks. So here's the final verdict. The bull case is powerful and simple. This is a picks and shovels play for the AI gold rush. They are selling the one thing every AI data center absolutely must have. But the risks are real. Number one is execution risk. Can they actually build and deliver on these enormous contracts? Number two, they've got competition from companies like Plug Power. And number three, they're carrying a decent amount of debt. And as we just saw, the stock is technically overbought in the short term. You have to weigh all of that. And as always, a quick reminder. This is just for informational purposes. It is absolutely not financial advice. You've always got to do your own homework and consult with a professional before making any investment decisions. Hey, if you found this deep dive helpful, do us a huge favor and hit that subscribe button, give this a like, and maybe share it with a friend. It really helps us bring you more unbiased opportunities before you put your money to work. And hey, one more thing. Is there a specific company or ticker symbol you want us to break down next? Drop it in the comments below. We read every single one, and we love getting ideas from you. Thanks for watching.